when we're out in the road, what we're talking about are three principal fundamentals with our stock, which we think differentiates us from the rest of the pack. One is obviously around the stable cash flows, which is not dissimilar to the others in the pack that we often get measured against. And I'll talk to that in a moment. The second one is the development pipeline, which is very unique. And the third one is what we've done around the balance sheet, and I'll talk about that very quickly. So firstly, in terms of the stable cash flows, you all know the story with the toll road operating model. So very stable cash flows, very stable traffic numbers in all of our core markets. We're seeing great, stable and reasonably solid traffic growth across Sydney, across Brisbane, across the US, and also in Melbourne, albeit some of the headline numbers from a Melbourne perspective are somewhat low because we're doing a widening of what's called the Tulla widening project, which is really the section of the road that connects CityLink up to the airport. That's a major project for us. It'll add about 30% of lane capacity to that corridor when it opens towards the end of the next year, but obviously we're having to deal with a bit of disruption. Really pleased with how that's going. And another thing that's really important, and when we try to structure these transactions, we try to ensure that we get offset cash flows coming through. So one of the big offsets there is 1 April next year, we actually get the truck toll multipliers on CityLink going up from the mid-2s at the moment to a 3 times multiplier. So albeit we might have softer traffic numbers along that corridor for another 12 months or so, we're actually going to get an uplift in revenue, which again is another great offset. So just demonstration that we've constantly got that nice growth, consistently strong growth in traffic numbers and in revenues. And obviously all of our revenues are inflation linked as well, which means to the extent that we have a rising interest rate environment, then to the extent you believe in 101 economics, you'll see that inflation rates are going up as well, and we can obviously pass that through on a pricing perspective. So again, that's quite unique in terms of how you'd compare us to the rest of the sector. The second one is the development pipeline. So we've circa $9 billion development pipeline that we're working on at the moment. That doesn't include the works or the potential works going on with WestConnex in New South Wales, the potential sell down of those New South Wales assets. But putting aside that, we've got already in discussion a $9 billion pipeline. And again, I don't think there's too many other companies, let alone in our sector, but in the market that have that sort of pipeline that provide us with that long-term growth that we're looking for. Our ability to execute on that pipeline was demonstrated last week when we announced here in Brisbane the Logan Enhancement Project, albeit a relatively small project at around $500 million. Again, another unique opportunity to find value sources to fund that, where we've increased the truck toll multipliers here in Brisbane, which effectively on that number gets us up around 3.4, 3.5 times the charge for trucks that we charge cars as we progress through the development of the Logan Enhancement Project. So again, another value source. And the third one there is around the balance sheet. So we've been working very hard at making sure we've got a very robust balance sheet. Obviously, it's structured in a way that maintains strong investment grade credit metrics. So we've got that BBB plus Baa1 rating. So very solid, high investment grade credit metrics, which gives us stability in the balance sheet, but also great access to funds. We've been very active over the last 12 months, clocked up a number of frequent flyer miles, done about $4.6 billion, close to $5 billion worth of new issuances, most of that to refinance existing debt and try and take advantage of the low rates, term out shorter term debt that we had in the past. A lot of it was to fund the Queensland acquisition here a couple of years ago. So really termed out that short term debt to put into place longer term capital markets debt. So we've got an average tenor of almost 10 years now, so between 9 and 10 years. We've been able to raise that new debt at attractive rates, lower than our previously reported average cost of debt. And we've also structured all of our debt now where it's about 99% hedged. You can say 100% hedged. So to the extent that we've got rising interest rates over the next few years, then we've got protection against that average tenor of around 10 years. So with that, just bringing it back, again, very pleased with the way that the assets and the operations are performing. All of our construction projects are on time, on budget. The development pipeline is strong and robust. We did miss out on one project a couple of months ago in the US, but again, we'd like to believe that that's a demonstration of our strong discipline in terms of the way that we manage the business and grow the business, and obviously the robustness of the balance sheet we believe sets us apart. So